Welcome everyone to Name Confidential Live.
Hey guys, welcome back to Name Confidential. Finishing up another 2025, just bloody Friday, it would seem, in the markets here. And today I'm joined by Katara of TappAlpha, and he's joining us today with an interesting idea of something that he's been utilizing, kind of picked it up in 2022 in the volatility of those markets as a way to just, if you're going to own something, how can you be more efficient with it sort of idea. And so with that, I'd love for you to just introduce yourself a little bit, maybe tell everyone a little bit of your background, what you've done, and a brief overview of kind of what you're doing with your strategy here, um, that zero DTEs have provided this new opportunity, this new market instrument, if you will.
Yeah, no, appreciate it. Great to be with you. Yeah, there's been a trend of these Bloody Fridays, so it's been interesting to sort of pick ourselves up off the ground for these conversations. But really good to meet you. Brendan and I just met, a few weeks back, and I was really interested to learn about NAIM as an organization and sort of the active management idea. I actually came from a totally different background. Came from a technology background, went to go work at a startup in Silicon Valley in the early 2000s. Actually founded my own technology startup and then built it and ran it for 17 years. But that's what ended up bringing me actually to finance, because in October of 2022, I ended up leaving the company that I had founded to figure out what the next adventure would be. The challenge with that, though, is, how do you make ends meet? And so I was sort of faced with that reality, and we were kind of chatting earlier. The other challenge was 4 months from the date that I left my prior job, we were about to have our first baby. And so you feel that financial pressure. And I had always kind of been, a passive buy and hold investor. I bought SPY. But in October of 22, I didn't want to have to actually sell SPY shares in order to make ends meet. So that's where I ended up employing a strategy I learned from my dad. He was a engineer turned advisor, and he's like, you can sell covered calls. I was like, okay, I'll try that. But the novel thing that happened right at that time was 0 day covered calls just became available. And so for folks that aren't familiar with that, there are calls that just expire essentially the same day. You open it in the morning, and then 6.5 hours later, it expires. And so that actually enables some really interesting things, which I'm sure we'll get into. Well, fast forward a couple months, just the options premium that I was able to collect from my SPY shares was covering the lion's share of our family's mortgage. And for us, that was such a huge financial relief, especially with the baby coming around the corner. It was amazing because I was able to be focused and not miss a thing for my daughter's first year while I was figuring out what the next business would be. But long story longer, the hard part of the strategy was you're doing it every day, so it just took a lot of time. Well, with the technology background, wrote some tools that helped me take, 3 to 4 hours of work every day down to under 5 minutes. And that was where I realized, oh my gosh, this is the next business. So just basically doing short dated cover calls in the S&P 500 as a starting point. You can do it on any security, but I was trying to figure out how do I get it to market. So met some folks, ETF issuers out of New York, and they're like, you should just take this and wrap it in an ETF. And that's what we ended up doing. So we launched T-SPY, our very first ETF, middle of last year, August 15th of 2024, and have been sort of up and running that strategy since then.
Yeah, so like let's talk about the market structure of zero DTE. Um, I think like that's really where I want to focus is like what is that? Why are people doing it? I like primarily what I'm seeing is the content around like, hey, it's the degen gamblers, like market's down, they're buying a, deep out the money call for, a penny and they're hoping they 10,000x their money because there's a swing at the end of the day. And, and they're just giving away premium or something, and it's the degens using these zero TTEs. Is that like in your research? Is that the case? Like who's on the other side of this trade, right? So you're the one selling it in
Yep.
your sort of idea, but like why is there a marketplace for it at all?
I think there's a couple reasons for it. So yes, there is the lottery ticket buying, and that's what gets all the headlines. But there's also sort of targeted risk mitigation as well. So you can buy different options. Let's say you have an event that's happening on a given day. Let's say there's an economic report coming out, or a great one, you see it every Fed meeting, FOMC meets. People want to place either bets and sort of exhibit an opinion of what they think is going to happen, or they want to protect the assets that they have, but on a shorter basis for a lower cost. So you can use options in defensive ways as well as the lottery ticket buyers. But if you look at SIBO's statistics, so they keep all the stats on, is the market balanced? Is there more buys than sells, more sells than buys for both puts and calls? And they've seen really even distributions for buying and selling short dated options. And in fact, beginning of this year is when 0-day options on the S&P 500 are now more than 50% of the option volume on the S&P. So there's popularity there. The headline catchers are, of course, the lottery ticket buyers, but there's lots of ways to use those options when it comes to protecting positions and for other strategies.
Am I crazy to I don't know. It's funny that you call it the lottery ticket. I generally don't like a lot of references that equate anything with investing and gambling. But that being said, the idea that the people buying a 0 DTE, a retail trader buying it or whatever, and they're buying the lottery ticket, I think that analogy sort of fits, right? Like they oftentimes would probably not have maybe the expertise or insight or whatever information they need to say, like, oh, this is going to reverse by end of day. I'm buying a super, super cheap, highly risky option, and have any kind of calculation around that. So it is sort of that lottery ticket. When they win, it's great. All else being equal, if I could be the state being the guy selling lottery tickets, it sounds like a pretty good deal. Like
That's
I'd
part of
rather
the
own
idea.
the casino than play at the casino type of deal, right?
Yeah, to your
Um,
point, like I agree, don't like to make the gambling analogy so much, but that's a one that kind of fits in a way.
yeah. Anyway, so like, how does that work? So how does that work? Like, if you're going to sell 0 DTE and there's, I mean, the theta decay, right, is just rapid, right? I mean, you're literally like, while you're waiting for your computer screen to load, it's like the value is going down, you know what I mean?
Mhm.
Like, or up, and your execution's goofy. It's like, what are the complications with execution on something like this? Like, it just seems like there's markets move so fast, information is so fast. Like this is like, could latency, like seriously, like the latency thing, or like that high frequency traders deal with, like have the same kind of impact on something like this?
Yeah, you sort of nailed it. If everyone's kind of seen the theta decay curve, and the steeper the line, the better for an option seller because you're selling something that will then go to zero, hopefully very quickly. That's exactly what we're taking advantage of in these strategies. But to your point, there are big movements, and especially as you've seen more volatility creep into the market since the beginning of the year, those movements get pretty dicey at times. So you can actually play those strategies in different ways. The end goal, at least the one that I've found, statistically you can figure out what's your sweet spot. And for us, it's 80-20. 80% of the time, we want to see those premiums go to zero. So we sell it, we get to keep all the premium. 20% of the time, sometimes it goes against you. And so that's when you have to do some risk mitigation, and having real-time data, quick systems, sort of looking at the right signals is incredibly important when you're managing these sorts of strategies so you don't get behind the 8 ball and end up being on the wrong side of a big upward move when you're doing a covered call strategy. So yes, they move fast. They move, and part of it is like delta is one option, Greek statistic that is really good to look at. How much does the option move with respect to the underlying? We're always looking at 25 delta or less as our starting point, and we're trying to stay away from 1-to-1, so that you end up not having to get really behind the 8 ball, because you could be collecting X dollars in premium, but if it gets behind you, you could lose 10X of that premium in a day, and so it's going to take you 10 days to catch up. So you've got to be very careful from a risk mitigation perspective when you're selling options too.
Well, if you're covered in the position, how does that work if it goes against you, right? Like, because theoretically it's covered. So if it goes against you, right, you sell it, you get the premium, and you get called away, right? So how do you end up losing?
It's so that's where we're losing is really in this case defined as not winning as much. So you get
Okay.
capped.
So the introduction of tracking error from what your expectations are initially, right?
Say it again.
Like just tracking error. So, if your initial expectation is to get, such and such result, and now something's gone against you, the the nominal result might still be positive, but net of a tracking error, it's negative.
Yeah,
That's kind of
yeah.
what you're saying. Yeah.
That's one way to look
Um,
at it. Another kind of macro way to think about it is, let's say the market over a year, just to give a longer timeline, goes up like we've had over the past couple of years, 25%. When you're doing a covered call strategy, a lot of times, typically in a sort of a bull rally market, you'll likely trail the underlying. But because you're using short dated options, it's way easier to sort of keep the market like returns so that maybe the market does 25%, but you're able to get, 23 and then generate income on top. That's like the worst case scenario for cover call strategies is when there's a big bull rip. And then if you're already sort of an index investor or directly into the market, you still have that downside where the core underlying security could go down as well. But in that case, at least you're padding that downside a little bit with option premium over time. So those are the
sure.
two Achilles heels of these types of strategies.
Yeah, that's so how does, because the volatility can be huge in zero DTE and it's daily. Um, I know like the S&P like buy right index, it like underperforms the S&P like what 6% a year on average.
Something like that.
By
Yeah.
writing those covered calls, and that's writing systematic 30 days, at the money. It just underperforms like structurally, right? At this point. So is there a structural advantage or disadvantage to using 0 day versus monthly calls, or is it just a different type of risk?
There's three benefits or differentiators for zero DTE calls. Number one, you get a premium on the premiums. So the way I think about it is if you're doing a 30-day cover call strategy where you write one call at a 25 delta risk level, you'll get X in premium. If you take that same delta, so 25 delta calls, and you just write that same call over the 22 trading days in that month, you'll actually get 4 to 4.5 times the premium. So simply for the same risk, you get a significantly better risk-adjusted return just on the premium value of zero-day options. And the reason for that is because of the underlying popularity and volumes of zero-day options. The second thing is you avoid on your short position all overnight risk. So at night, when markets maybe rip because of some after hours news, you'll catch that with your long position, but your short call is risk off. So you're only trading it that 6.5 hours a day. And there's some statistic called the night effect where 66 or 70% of the time overnight, you're going to get upward swings and so if you're risk off with the option position, way easier to mitigate risk. And then the third thing is you get 22 at bats to reset your strike price through the month versus one. And so the analogy I use, like if you're flying from New York to LA, it's like taking off from the airport and you get to point your airplane in the direction one time. And you start perfectly, but then when the winds kick in or the thunderstorms come and you get adjusted, you can't actually adjust where your position is. But if you use a zero-day strategy, you can actually adjust your flight path 22 times along the way, which gives you a much higher percentage or higher probability that you're going to land where you intended. So those are the three main differentiators structurally of how zero-day works differently than 30-day. And then, you actually have a shot. You can't guarantee it, but you have a chance potentially to outperform the underlying benchmark depending on how risky you play it from out of the money perspective.
Yeah. So I'm sort of thinking like RIDEX funds, right? Like they're kind of the OGs in the leverage mutual fund space, right? And they have, daily reset mutual funds or they have, monthlies. And if the market's trending, you can compound your leverage starts to re-leverage, right? And so you can actually outperform the underlier in a positively trending market by more than 2 beta. And what's interesting also though is like with those funds, if it's a trending market down because the leverage is sort of like deleveraging itself every single day, in a strong downtrend, you would actually like outperform too by not taking a full 2 beta drawdown, assuming the trend's strong enough, right? Like I don't, just from a pure mathematical model.
Mm-hmm.
So how does that work with something that's like zero DTE, where you have this income that now is, it's like, are you buying, is the idea for an investor doing something like this to buy more SPY, or do you have more, premium to hold as collateral, or to just immediately that day essentially take it out of production use and just say, yep, that's premium from yesterday, sort of living on the income type idea, like you were saying earlier. Like what's
Yeah,
the,
we
it's like,
and
are
you
you, are you compounding your growth? Is the compound growth helping you? Does it do anything to hurt in a strategy like this? Or is
it
that
can
just
help.
behaviorally
Yeah,
kind of looking at it all wrong?
that's a great actually kind of watch out. It's a nuanced one, but an important one. So if you're a growth investor, there's no reason that you wouldn't just take the additive income that you've generated and plow it into the underlying if that's what you're looking for the long-term growth. If you're an income investor, there's no reason you wouldn't take the subcomponent that you need from the income generated and take it off the table and use it. And that's actually one of the things that you can decide either from an ETF purchasing perspective, or if you're running the strategy yourself, decide what your income requirement is and then adjust your distribution accordingly, and then you can manage it that way. We ended up picking the middle ground where we're one of the few funds that talks about both capital growth plus income in the zero DTE world. A lot of them really talk about just as high a yield as possible. And so you
Yeah,
can create a balance that checks the box for whatever you need as an investor.
yeah. Um, so what's your take on like the current just market environment as a whole, right? So you have like name exposure index this week dropped to like 57. It's a huge risk off. Not the lows it's been in the last 18 months or so, but it's like getting down to the bottom of the range, right? Um, some
Mhm.
people will say that can be somewhat of a contrarian indicator, right? I think that's generally just sort of because of the amount of trend following that's within the community. And when the trend breaks down, people tend to get risk off.
Mhm.
And once everyone gets risk off, you know, it doesn't take much buying to start reversing the trend, right?
Yeah.
Um, but I, there's so much volatility in the market right now, and it's like it's just both directions. What's your take on the whole thing?
I think it's interesting. I think about this as an engineer might. It's having the right tool set to harness the thing that you're looking at. So, for example, when interest rates are high, bonds could be a certain place to capture that interest. Well, what's the tool that you use to capture volatility in the markets? And the answer is options. So you get a tailwind, but you need the right tool, the right sail to catch it. And you got to play it in a way that's in line with your risk profile. So while 2025 has been a wild ride, up and down, either direction, that volatility is actually something that can be harnessed, captured, and then transferred into cash that can pad some of the downside or help you get some alpha for whatever your underlying is, depending on how you want to play it. So yes, it's crazy, but do you have the right tool to capture what's happening in the environment right now? For us, it's actually the ideal time to launch options-based strategies because the premiums are tied to that level of volatility directly.
Um, so I mean, whether a storm with some options income, I get that. Just from a macro thesis though, or the way that you look at markets, you're looking at, like, in your strategy, you're looking at markets on an intraday basis and saying, what's my projection for today? You sort of, I assume, would have to be, because otherwise, if you just are systematically saying, well, I'm going to sell an at the money, you know, call on open, you're going to get called away, right? Statistically, more days than not, and
60
that's
plus
going to
percent
be
of the
sort
days.
of,
Yeah.
kind of goes back to the same issue that like the 1 month kind of buy rate strategies have, right? So you've got to be having some kind of input or analysis on market internals, health of the market, mean reversion. Like I mean, I don't know exactly what you're looking at, but what's your general take? I mean, is this is like going to keep breaking down? You think we're going to get the reversal? You think we're going to put in a rough and volatile bottom here? I mean, where are you at with it?
Yeah, you said, and so you're spot on. There's dynamic inputs that drive the decision making. So we harness a lot that are from the back end you can pull from your data sources. For example, obviously VIX level, volumes, all the theta, all the Greeks like theta decay and gamma is a big one you can watch, RSIs, all the stats, right? But what's interesting is they're all being driven by uncertainty, and a lot of it is policy related. So the other big input to us and where we take positions is based on planned and unplanned events. So planned events, we hear, we absolutely take a different tact and with caution. But like one sort of newly planned event that's coming is April 2nd. There's going to be a big trade policy discussion from the White House. That's going to have huge input with respect to market volatility and what happens and how the market ends up interpreting it. And it's everybody's, nobody's got a crystal ball, so you don't know what it's going to be. But it's that level of uncertainty for things that are unplanned that make it difficult. But when you actually have a little line of sight to something that's planned, because you have day-to-day granularity, you can actually play it a little bit more flexibly than if you're stuck for a 30-day period where there's all these things happening throughout the period where you're short in an option. So that's, I think, a really interesting capability of having more granularity.
So net April 2nd, right? Like if there's just more implied vol, right? And options are going to always have the highest amount of implied volatility right before the event, right? And the lowest amount immediately following. And so it's one of those things that goes from, creeps up to 100 and then immediately goes to zero, right? Like anyone that trades options or on earnings or something like that, they're familiar with this. And you can lose, like if you could go trade earnings options around earnings on an earnings announcements or something. And if you kind of time that trade wrong, it doesn't even matter if your call was right on the direction of the underlying, you end up paying so much for the volatility or like the option that you can sort of lose even if you're right. It's a really unsavory dynamic of options for a lot of people. How does that play? So like in April 2nd, so you just have more and more increase vol, more and more increase vol. And all that is like, it's essentially like leverage and risk at that point, right? Because you can just say, okay, market neutral, it's just too wild. There's too much implied vol in either direction. It's now become leverage from a portfolio management standpoint. And if we're wrong on the call, it's like, it's too much directional leverage. It's too much magnitude. So sort of through the same math or lens that CTAs might think about it, right? It's just too much vol. We got to back it down and have that volatility control and just don't participate, right? Just be flat. Or you can make a sort of a directional call and say, okay, I'm going to so now there's these zero DTEs coming to April 2nd. Naturally, you will be a seller. That's your strategy. But somebody could take the other side of that and be like, morning of April 2nd, man, I'm buying right before the announcement. Let's see what happens. And if it rips, it rips. But what's interesting is like they might pay so much for the implied vol that the underlier might actually move in their favor. They still lose on the premium costs, right? Like they still lost money overall. Even if it goes in the money. How do you come into an event based like that and then say, yep, we're going to sell at the money, or we're selling deep out the money, or we're not selling at all? Naturally you're on the sell side, but like, how does somebody do the quantitative analysis to do that? Or is it like, this is what we think, man, we've been doing this a long time and it's just, our instincts.
So there are absolutely ways to do that where you can kind of make the bet. We're a low to moderate risk profile, so we just simply don't guess. We wait. Because if you ever watch option premiums on the day that Jerome Powell speaks, the amount that you can sell it for at market open is almost identical to the amount you can sell it for at 1:59 p.m. right before FOMC ends up putting out their report. And then the press conference is a whole nother thing. So why am I going to take all that time risk just to get paid the same? If I want to make a guess, I want to make it right before the event, but I don't make a guess. I wait for it to happen. I wait for the market to react. And then I take a position because there is inefficiency in the marketplace. So if it starts to drop, you can actually capture a good premium after the event and let that sort of peter out till the end of the day. Or if it starts to rip, you don't have to actually take your position. You can take it way further out of the money versus where you would have been in the morning. So I don't guess. It's like I'm a terrible at analogies, but the analogy in my mind is like when you watch soccer and they're doing penalty kicks and you see the goalie kind of has to make a bet one way or the other because he doesn't know where the ball is going to go, and so he guesses before the actual PK is kicked. We just have the position where we don't have to guess and we'll wait to see what direction it goes, and it's moving slow enough for us to actually get in front of the ball. So we just don't make a guess because we're low to moderate risk. But you're spot on with people that want to play that game. They can play it, and those events are really big days for them to do that.
Yeah, big wins or I don't know, modest losses, I guess. I don't, that's the nice part about options, right? Is you have a quantifiable downside risk,
Yeah.
right? At least if you're long the option, like if you're selling the option and you're like, own naked puts or something, or sold naked puts, that's totally different. But or sold naked calls even. But if you're, yeah, anyways, my point is if you're buying calls, you have a quantifiable downside risk, which is you lose your premium. So I think that's the thing that is attractive to people is, hey, I'm going to keep running I'm going to make my calls over and over again. I think if I have 51% accuracy, I just have to buy 0 DTEs at enough event driven days where I think I'm good. And I might lose this tiny premium over and over and over again, but eventually I'll have to hit, and it's so big it could, perform that way. I think that's got to be the math people are doing. I don't know.
I think so. I think it is, but it's definitely a very calculated risk, and you got to do the math right because the whole winning and losing this game is risk mitigation. And so if you don't do the math right and you're off by a couple of percentage points, you lose your edge, and then you end up losing on the strategy. And that's the hard part. For us, we play the other end of the calculus where we're 80+%. It's in our favor. But that 20%, you got to be real careful because when it does go against you, you can lose a significant amount if you don't have the right risk mitigation in place. And that's where you win or lose in these games.
Yeah. Well, I appreciate you giving us some insight today into like the 0 DTE markets and some ideas for people that are portfolio managers out there and how they want to handle, different market environments, different instruments that are available now. You're the first person I've talked to that trades 0 DTEs at an institutional level. So that's a unique perspective and insight. The only other people I've met that trade them are on the opposite side of the trade and they're retail. And I have never traded them myself personally, so it's a new and exciting stuff to me. So hopefully the markets firm up here. I think everyone that's not short would love them to turn around, but
Yes.
I think there seems to be a lot of uncertainty. We'll see what April 2nd brings to bear for everyone. It seems like the volatility market's sort of pricing in a lot of certainty after April 2nd, which I think is a little peculiar. And I'm not sure that it's going to, usher in a bunch of certainty given, Trump's style. So, well, it remains to be seen, but it'll only a couple more days away here, and we'll know. So, with that, Sai, appreciate your time. Thanks for getting on, supporting NAAIM and the organization. Anyone listening out there, just a reminder, really quick: the next conference is the NAAIM Uncommon Knowledge Conference. Awesome conference. I've been going for years now. It's helped me a ton. I've built relationships. I've learned things. I've gotten industry insights, investment insights, all kinds of stuff. It's been awesome for me professionally to go and attend. It's in May down in Costa Mesa. You can find more details on our website about it at naaim.org, name.org. So thanks again, Sai, and hopefully we see you soon.
Thanks for having me.